Your career feels stuck. You're waiting for that perfect opportunity to come along. But here is the truth. Opportunity isn't something you wait for. It's something you build. Welcome to NISM e-learning, where your financial career takes flight. We are NISM's online learning platform. Whether you are starting fresh, switching careers, or sharpening your edge, we are here for you. Quality education, affordable pricing, zero barriers. No matter where you are or when you learn. Industry designed courses from securities market veterans with decades of real-world expertise. From foundational financial literacy to specialized expertise, equities, mutual funds, derivatives, compliance, risk, wealth management, and beyond. NISM e-learning course covers securities markets areas comprehensively. This includes topics related to mutual funds, financial planning, SME listing and compliance, forensic investigation, anti-money laundering, and more. Every course is built with leading knowledge partners and academic experts, thoroughly vetted and constantly updated. Your journey starts now. Visit online.nism.ac.in today. Learn at your pace. Learn on your time. NISM e-learning. Build your future.
First, let me just share my screen. Very good evening to all the participants. So the today's topic is data-driven investment strategy from insight to prediction. The logic behind taking this topic is nowadays in the securities market domain, the lot of data is available. And without data analysis, we cannot do any investment strategies because in securities market, the investment strategies cannot be based on the feelings or any intuition. So basically, whenever we have the data, we need to rely or we need to analyze the historical data or real time market data, and we need to develop the investment strategies. So in the today's world, the lot of things are coming up to predict or to forecast the future values. There are a lot of algorithms has been built, how to manage the risk, how to do the investments, what are the different types of tools available to, and what are the different technology. Because as we are moving towards the technology, lot of technology innovations are coming up in the market. Because suppose if we have a data, and without data analysis, if we are doing any like a predictions or any strategies we are building, it's very difficult to get the good results. So it is very essential. So the basic idea to take this topic is we need to discuss about the what are the different investment strategies. Basically, again, the we will also discuss about what is the data driven investment strategies, what are the prediction methods, what type of data you can take, and what are the different scopes are available. So there are three agendas in this webinar. First, we need to understand the data driven investments. Then we will move for analyzing the data for insights, because taking the data and just making any analysis will not make any sense. So we need to identify that what type of data you will collect, what type of analysis you will do, and the basic thing is how to build the business objectives, or maybe the not a business objective, even individual objectives. Because suppose if you want to make an investment in stocks or in maybe in the bonds or in a different market, you need to first identify basically what is your objective, how much money you want to invest, what is the risk parameter or what is the risk capacity you have. So the basic problem, or I can say the basic first level of investment strategy is identify the individual objective or the business objective. And then we will move from understanding the data, type of data, what type of methods, what type of models we will use. So here first we will start with understanding the data driven investments. So basically the data driven investments are only not refer to doing the data analysis, but based on your intuition, based on your expertise, based on your experience, what you feel that what type of data you will take. Once you take the data, then you will go for the extensive data analysis and then you will take a financial decision. So basically this methods combines the lot of statistical tools as well as the market insight to see the performance. Because when we are doing with respect to the investment, we need to identify that exactly what we want to do. Second, we want to see that how the market is performing, and based on that, we will just analyze our data. So there are different examples. Suppose based on the price pattern, also we can identify the market returns of any particular stock. Then we can also see the probability of the particular investment, that how much is the probability that it will go up, it will go down. So it is not based on the intuition. We need to do some of the analysis. We need to build our portfolio. We need to decide the strategies, and based on that, we see that how much is the probability that particular assets will go up. So basically, data driven investments are, if you just see in a practical life, that will make more sense as compared to the intuition based. So, second thing, as we are moving in a technology frame, now there are a lot of online data is available. Huge data sets are huge number of data is available in the financial and the securities market. So it's very necessary that we need to develop the models which will work automatically on the machines. It is not that way we will do some analysis, and that analysis on the everyday basis we will do. It's very difficult. So in that case, we need to just prepare some model in some by using some technology, and that model we can fit in the machines, and then the as we put any value, automatically the model will run and will give you that when to buy, when to exit. So basically the algorithms we build in that case. So here in the competitive age, we can say we are able to identify the trends, because it will reduce your risk factor as well. And basically when we reduce the risk factor, ultimately it will be come to the better returns on investments. So data driven investments are more accurate as compared to intuition based. So some of the examples of data driven investments, just I took to just how it is implement in the real life. Suppose if we are going for the stock selection using financial ratios. So suppose if an investor wants to select the undervalued stock from the Nifty 50, so he will take lot of ratios. These are only the three ratios I mentioned, but there are a lot of ratios we need to take and analyze. So suppose the P ratio, we can take ROI of the company, and then the EPS and the debt to equity ratio. And based on this screening model, what we will do, we will just do the optimization. Suppose if P ratio increase by 10%, 20%, ROI will increase or decrease by some of the percentage. What will be our the performance? So in this case, when you are selecting any particular stock, some of the ratios we need to finalize by using the optimization model. So sometimes we can say that the P ratio is less than 20, or ROE is greater than 15%, and the revenue growth is greater than 10% per year. So automatically the system can filter out and give you the shortlisted stock based on the historical data, which will perform under these three conditions. For explanation, I took these three conditions, but there are a lot of other things are also available. Is we need to collect, like what is the dividend declared by the company, or what is the view, what is the balance sheet, what is the view of the investors on the particular stock. So there are a lot of things we need to take together, and we need to build our model. And based on that model, we can just put some filters and we can just educate the machine that if suppose this of the case, these are the criteria to be followed, what are the stocks will come under that. So manually it will be very difficult. So we need to adopt the technology and we need to do some data driven analysis, and then we can go for the investment. Similarly, if we can just go for the second example is the algorithm trading, because nowadays lot of algorithm tradings are. So basically algorithm trading, the trading firm use these algorithms to find out the historical price pattern. So in this case, algorithms are built under the, again under the different condition, but basically they define the two objective. Basically, the first, if a stock of 50-day moving average cross above its 200-day moving average, so in that case, the automatically the algorithm will give you the result to buy the stock. So if volatility or the risk increase at a certain level, it will reduce the exposure. So such type of criterias we need to train the in the algorithm, and or we can use some machine learning techniques to predict that if 50-day moving average will cross 200 moving average, the algorithm will say to buy, but which stock to buy, which stock to sell. So all these conditions will come automatically in that case. But here again, a back testing strategies will also be put in the algorithm trading, where we can also give our justification, like if moving average cross over the given 12% annual return from last 10 years. So based on this criteria, based on this data, the firm will automatically do the live trading. So this is the most important, or I can say the coming up application of data driven investments with respect to with respect to the financial market as well as the securities market. Now there is one more most important application is the portfolio optimization by using the statistical tools. So here we basically, the investor use the modern portfolio theory, because the modern portfolio theory is basically based on the historical returns, then we can say standard deviation, that is a risk factor, and the correlation between different assets. Because as we want to make a portfolio, we need to understand that what different type of asset class we need to take. Because suppose if I want to make an investment of 10,000, see, 10,000 is a very less amount, but yes, but if I want to make an investment, I would like to understand in my portfolio how much percentage of different, like a money I will invest in different asset class. So basically, the portfolio optimization models will do all these things, where we can consider these three factors: risk, returns, and the correlations between the assets. So automatically the statistical model suggests that out of total money, you can invest 40% in equity, 30% in debt, 20% in gold, 10% in cash. But in this case, the objective will be always clear that the model automatically maximize the return and it will minimize your target return of 10%. That is also the one more example which basically we use in the safest portfolio design and preparing the portfolio for the investors, to prepare a portfolio for the investors. Then in the different sector allocation also, the macroeconomical data is available. So we need to find out how this macroeconomical data will impact the different sectors. So the fund manager always analyze the macro data, like suppose the rising the interest rate. So in that case, if we can say, if we are the interest rates are rising, so the bank stocks are likely to perform better. But in that case, this is an intuition, or it is a link-based macroeconomic data, because automatically if the interest rates are rising, so the bank stocks will perform. But in the real life, we need to find out, or we need to predict, or we need to forecast whether is there any relationship between the interest rate and the bank stocks. If there is any relationship exists, then this type of interpretation will work. But if suppose there is no relationship between the interest rate and the different stock performance, maybe in that case the opposite scenario will work. Because in market, this is the intuition or this is the perception that the interest rate increase, the bank stocks are likely to increase, but not necessary. So through the different data analysis tools, we need to find out whether there is any really or there is any analysis or there is any relationship between these two factors. So that is the important thing. Similarly, if we can say increasing the oil prices, the energy sector likely to gain. It is a general perception in the market, but not necessary. Again, we need to find the relationship. Sometimes I always, in a practical experience, I always say like 50% time the perception will work, but 50% time we need to take a decision through data driven investments or data analysis. We need to do that. Similarly, high inflation FMCG stock may struggle, but again it is a perception in the market. We don't know whether it will be, because again there is a relationship does not exist, so it will not work. So based on this insight, maybe the fund manager increase the exposure to banking and energy sector, and he will prepare the portfolio in that way. He will suggest the investors that this much of highest percentage of money you can invest in the banking sector, and the next you can move to the energy sector. So these are some of the examples of data driven investments. Now, second, I would like to just give some of the concept like why data-driven investment gives a competitive edge. Because it is also very important, like really the data-driven investments are making any changes in the market while for the investors. So the first, I would say, identify the market trends early. So basically, if we know the market trends early, then maybe our decisions will be more accurate. See, 100% accuracy will not be there, but yes, we will try to minimize our error factor. So in this case, if data driven market trends are based on the stock as well as the mutual fund or many other factors as well. So while defining the trends, so I will give you one example, like a mutual fund basically use the historical stock prices and the machine learning model to see the momentum in the different sector. So suppose the model detect increasing trend, trading volumes and the consistent price growth across the different sector. So based on that, he will maybe suggest that the fund reallocation 20% or the maximum allocation of the portfolio towards that sector, because we will understand the trend, particularly we will understand the trend based on the volume and the consistency price growth, and based on that we can suggest that how much allocation we can do, and based on that maybe the government also will take a support, will give the support to that particular sector, so that the sector can outperform and give the higher return. So that are also the chances while doing these things, while doing the data driven investments. Now second, reducing the investment risk. So because whenever we are making the investments, the risk is the important factor. So always there are the tools available. We will try to help in measuring and minimizing our risk factor. For example, if I can say that the investor always use the value at risk, VAR coefficients, then beta coefficients, standard deviation, and the stress testing using historical data. So, for example, suppose if I have two stocks to make an investment, like a tech company and the stock B of the pharma company. But by using 5 years data, we understood that the stock A is more volatile. Stock A is having the more volatile and the risk is 25%. Stock B is volatility is 10%. So in that case, stock A gives more higher return. But again, we need to concentrate on the risk factor. So the risk factor will come under the standard deviation. So, standard deviation is more. So we can say that there is a lot of fluctuation in the data. So anyways, the returns are high, but if the fluctuations are more and the risk is more, the consistency will be less. So in that case, that type of investment are very risky. So that is also a very upcoming trend in the market while doing or while making this investment. The third point, I want to concentrate on improving return through the strategy optimization. So basically, the optimization is based on the fact, because anyways we are having the real data set, anyways we have the historical data, and we are doing some of the back testing in this case. So basically, a traders creates a strategies like buy a stocks if RSI is less than 30, so oversold condition. Sell the stock when RSI is greater than 70, overbought condition. So such type of strategy has been decided by using the 10 years or 5-year historical data. So based on these strategies, we can take a stock market data, we can calculate the annual return, and we can just see how much is the risk factor. And we can just calculate the RACI moving averages, and we can build our own strategies to do the decision. The fourth part in this is the better asset allocation decision, because basically when we are asset allocation is basically for the investment purpose. So investor usually are very like want to check, suppose if this much of money I have, X number of money I have, I want to make an investment in a different asset class. So how I will build the portfolio? So in that case, again, if the portfolio part will come, we need to check a expected return, risk, and the correlation between different asset class. So we already discussed that as the different assets class is there, we can build a model which will maximize the returns and minimize the risk, and we can tell the investor that how much money they should invest in which asset class, so the risk factor will minimize. Now the this thing is also very important, because when we are saying data uh, driven investment strategies, so the most I cannot say, but there are a lot of confusion in this, that how we will take a different type of data, which type of data we should take for the analysis, or if you want to build some different portfolios, different strategies, what type of data. So basically, there are two types of data, quantitative and qualitative. But again, the quantitative data is based on the numerical values. So earlier, earlier days, we are using only the numerical value, because we don't have that type of tools and the technology to analyze the qualitative data. But now a lot of tools and the technology has been came up where we can analyze the qualitative data, like we can identify the market sentiment once the market get closed, what are the blocks has been written, what are the perception of the investors on the different stocks, what they think about the different stock. We can do some of the text analytics, and we can combine our quantitative analysis with the qualitative, and we can find out that which is the best investment strategy we can decide. So that is also the very important this one. We can also do some of the data we can collect from the financial statements, market research reports, news articles, and we can aggregate all that things, and we can analyze all that things together, and then we can come to the conclusion. So when we are talking about the data, there are different type of, some of the data will fall under the qualitative, some of the data will fall under the numeric data. So here there are just in a general, if I can say, there is a qualitative data and the numerical data. But type of data, basically there are different type of data we use in the investment strategy. The first I can just say about the market data. So basically the market data refer as a real time or the historical data about the financial and the securities market, which may be the qualitative, which may be numeric. So here we usually take the stock prices data, which where we take high, low, and high, low, close, opening prices, and all that things together. But that data will come under the numeric data. Then we also take the trading volume, because when we are talking about the market data, so market data, one first I will refer as a stock market data, high, low, close, open. Second will be the trading volume, because trading volume also make a sense in that. Then we can say the bid and ask price also is the important strategies. Then we can say the different market indices, how their performance is there. Then we can also take the volatility index to analyze the data. So all these market data components fall under the quantitative data itself. But how it is used basically, so investor analyze this data to identify the price pattern, trends, and the technical signals. So that will give you, so you can take a historical data, you will calculate the same moving averages and just take a call that when to buy. If for the 50-day moving average crosses above the 200-day moving average, it signals a buy opportunity or the sale opportunity. So that way we can consider this market data. But not only the market data will make sense. Again, the fundamental data is also the very important, because fundamental data is related to the company financial health and the performance. So which also includes that the revenue and the profit, which includes the EPS, earning per share, PE ratio, return on equity. So we need to take a cash flow statement, also balance sheet data, because once we take all these terms, financial data, fundamental data together, so basically fundamental data is majorly used for long-term investment, where we evaluate the asset is overpriced or undervalued based on the fundamental data. So basically in this, if I can just give you one example, that if suppose we have a company A, ROE is 18% and the debt equity is 0.3, and company B, ROE is 8% and the debt equity is 1.2. So based on the financial strength, maybe the investors will prefer to the company A. So such type of decision we can take through the data, fundamental data, not only the market data but fundamental data. The third source of the data also in the security market is very important, that is a technical data. So basically the technical data focus on the price trend and the pattern of securities market over time. So in this class, the data which we have, the moving averages, then we have RSI, relative strength index, MACD, then we have support and the resistance level and the trend lines. So basically, it will help you to identify the entry and the exit point of buying and the selling. So if RSI is below 30, the stock is considered as a oversold, which may give you the signal of buying opportunities. So technical data will give you the different strategies, will analyze the data differently. So all the type of data is having the different objective, as well as the outcomes will be different for all different type of data. Then also the macroeconomic data also make a sense in this class, because the macroeconomical data will give you that how the macroeconomical indicators affect your financial data as well. So interest rate is there, inflation rate is there, GDP growth will be there, industrial organization index is there, government policy changes, because that will also impact your strategy, investment strategy, while if we are going through the data driven investment strategy. So in that case, the investor also decide that which sector or asset class to invest based on the different policies. So that is also the most important. And there are different alternative data we considered, like social media sentiments, then we can say website traffic data, consumer spending data is there, how much application they download, what are their views on the social media for different companies, then credit scorecard and all that things also we use for the data-driven investment strategies. Again, there is one more different type of data we use that is called as the behavioral data. So in the behavioral data, usually which includes the fear and the greed index, new sentiment analysis, as well as the investor surveys, because sometimes the companies or the investors are doing the surveys to find out then market mood indicators, because it help you that to identify or to understand the emotional market movements, how the market moves with respect to the different data strategies. So while doing all this type of data driven investment strategy, we need to see that what type of data we need to use, either market data, technical data, fundamental data. I always prefer, suppose if you are going towards the investment strategy, try to build and take all the data together and try to build a model in that case, because now we have lot of tools and the technology which will give you lot of analysis and to predict or the forecast the future values. So basically, this we already discussed, like the market data price analysis, which is the trend identification. Fundamental data is the company evaluation, because fundamental, then technical will give you the entry exit decision. Macroeconomic data will give you the sector decision. Alternative data, unique insight, behavior will be the sentiment. ESG data, ethical investments. So where the green investments will come. So these are the different types of data we use while taking the data-driven investments strategies. Next, analyzing data for insight. So there are a lot of data analysis tools are there, which include the statistical methods where different models are available, and we analyze the data, we clean the data, we do some manipulation of the data and try to extract some meaningful insight from and we will make some assumptions and we will analyze the data and find out that what is the best strategies. Nowadays, there are a lot of machine learning applications also came up, which will help you to build the algorithms by yourself, and that algorithms you can just automate to the machines, and you can take identify the pattern and take the decision. So that will just like help you to take the decisions in the second. So machine learning applications are also available. So basically, what are the tools available? Suppose uh, already we discussed that what is the basic objective or what is the basic purpose of doing the data driven analysis. So first we need to understand that what you want to do in the data. Basically, suppose if you, so the purpose is the most important. Suppose if you want to go for the risk analysis, then the tools, there are a lot of tools available, standard deviation, beta and the var. If you want to find the relationship analysis, so if you want to find the relationship between market index and different stock index, a different stock market, or if you want to find the relationship between the commodities with a stock, that really the commodity is having any impact on the stocks or the different asset class. So you can use the correlation, regression, lot of methods are available. Then the third most important is the forecasting, prediction. So we can use the time series analysis where the technical terms, ARIMA, GARCH, that tools came up. And suppose if you want to do the trend detection, so if you want to do the calculation of moving averages or the RSI calculation, and if you want to connect the RSI and moving averages, and if you want to find out your indicators on your data to build a algorithm, then we can use lot of techniques are available. Then we can also take a market factor analysis, which will help you to identify that how many factors. See, whenever we are in the market, we don't know that what type of data we should collect, what are the different factors are important. Suppose if I just ask anyone, like suppose if I want to make an investment in mutual fund, so everyone will give me the different factors. Some will say like the performance of the company, or maybe the last performance, or maybe the different indicators they will suggest. But I will say some different techniques. I think sentiment is most important, news is most important. So basically, the market factor analysis will give you that what are the factors which are very useful to take in our study to analyze and to take a decision based on that. Then we have a event impact as well, so event studies. So any particular event, like for example, like in the COVID time, so what are the particular performance of the stocks before COVID, after COVID, if you want to compare with the geopolitical issues going on, that how the different stocks are performing in that type of behavior. So we need to use the different tool. Then nowadays lot of advanced AI tools has been came up, which will give you like a machine learning predictive model, forecasting model, then the calculating the risk. Only the thing is, lot of technologies are available, so you need to be very careful that which technology you are using, because nowadays I saw that when you are going towards the data driven investment strategies, everyone wants to learn everything. They want to learn Python, they want to learn Excel, they want to learn R, they want to learn many other tools and technology. But in my perception, if you are learning everything and if you are not 100% confident in one, that will not make sense. So you should be very clear that which particular tool you want to select and go in the depth and learn that technology. And because that will give you the confidence to do the data analysis, because the all the tools are working differently. And if you are now, the lot of AI tools are there in the chat GPT also. If you can type anything, it will give you the different solution. But we need to justify that, we need to do the empirical evidences that whatever the AI tool is giving us, you need to analyze your data. So you will not rely on the AI tools completely. You need to be make a system of yourself, to make a model by yourself and just see that which model will work, and what are the different tools we can use. But I statistical tools, but technology, I always suggest you to just take any one tool and then just do all type of analysis. And now, second, we will again go for the predictive analytics, because as we want to identify the market trend, there are two main perspectives will come. One is the historical data analysis, and second one is the predictive analysis. So basically, historical data is giving you the feel of how the last previous data is working, how the performance, or we can say we are reviewing the past data to understand the trends over time, which will help the investor, which will help the market, or which will help the businesses to take an informed decision based on the patterns, based on the historical outcome. But again, it is based on the historical data, so we are just identify that what is the performance of that particular company or how it will behave. But again, the next question will come, okay, the company is performing good and we will go for company A. So next thing came into our mind is, if suppose it will be good, what will be the forecast value? So under that, we usually consider the predictive analytics. So basically, the predictive analytics utilize the statistical algorithms and the machine learning tools, which will analyze the current, which will forecast the future trend, as well as by taking the historical data. So here in the predictive analytics, we take the historical data, past trends, and we can predict the future behavior and future strategy planning, and we will make a decision. So in a practical life, basically the historical data analysis and the predictive analytics will work together. So the first phase we need to clear is the historical data analysis, what your data is saying, what your data, because we are having lot of data available in this space. So we need to do the data visualization first. And first, when the data comes into our hand, we need to just see whether the data is clean or not, how much data we should take, because as large data you will take, the accuracy will be more. So that you need to find out. So once the data came in our hand, we need to do some cleaning process or the manipulation in the data. What are the factors we should keep, what are the factors we should remove. And based on that, once the clean data will come, we can do some analysis. First, we will do the data visualization to understand the initial performance of that data, that what is the highest value, what is the minimum value, what is the risk factor, and all that things. Initially we will do that, and then we will go to for the next advanced level where we can develop the algorithms. We will do the forecasting, like calculation of moving averages, RSI. So in that case, we can see if RSI and moving averages increase by 5%, 10%, what are the chances, how the market will perform, what will be the predicted value. So once the historical data analysis will finish, then you will move for the predictive analytics. So here, while building the predictive analytics, there are two things which is very important. I always suggest, like the model selection criteria, because all the models are not applicable. You need to find out which is the best model is suitable for your data. So choose the right predictive model, because it involves and evaluate the factors which are already exist in the data, so which will give you the expected optimal performance also. So first, when you select the model, there are a lot of model available in this data driven investments, so you need to decide which model you will take to like predict the future value. Once you finalize that model, then you need a testing and validation, because once we develop the predictive model, and if I can ask, or if I can tell my organization that, or if I can tell the investor that the price will go up, but next, how much validation is there, whether whatever the forecasting I am giving, whether it is correct or not. So in that case, the testing and the validation is the important part, where we split the data into two category, like a training and the testing. And after that, we can apply the cross validation to measure the performance of both the models, that how this model will build on the test and the training data set, and how much accuracy is there. So basically, validation means how much accuracy is having in your model. Suppose if I can say 89% my model will predict the correct value. So that validation is very important while doing the prediction of prediction of any forecast, the any data set. That there are the lot of challenges in the prediction, because data quality issues are there, because as we build the model, there are a lot of missing values are there, incorrect data entries are there, outliers are there. Because in this financial market, there is not a same way the data is moving. Sometimes the data will move very high, sometimes the data will suddenly come down, sometimes the prices will go up at very higher level and it will come down. So we need to be very clear that how many outliers are there, we need to remove that. So these are the challenges, but these challenges we can remove by the different options are available in the statistical tools and the technology we can use. Then the overfitting and the biases will be always there, because overfitting occurs when a model learns noise rather than underlying patterns. Because sometimes the model prediction accuracy is 98, 99%, but in a practical life, it's very difficult to get that. So such type of validation, if we are getting, so maybe the model is overfitting. So we cannot rely on that. So we need to remove the biases from our data set. So that is the most important thing. So this is the overall picture of data investment strategies, or what are the tools we can use. But in my perception, I always suggest that if you are going towards this data investment strategies, try to select any one technology, learn that technology, do the data analysis. And there are two things, like intuition is the only one part, but perception is the one part where we take a decision through perception. But you need to do the empirical evidences of your perception, and just check whether your intuition and your data analysis are working together, and then you build your strategy. That is the most important you need to learn, because as we are moving ahead, lot of in this space, lot of things are coming up, and we need to update ourselves based on this. So thank you so much. Now we will open for the question answer session. So Sahil and anyone is there, so we can go for the question answer session. How we can cover the bias over the period of emotional connections. See, biases are not removed from the model. So basically, we need to check the biases at each moment. Now, suppose sometimes if the prices are going very high, so we need to check that at what level that prices are going high. So what are the different parameters are there? We need to check that. So directly we cannot remove the biases in our data because biases will come in seconds and in a minute. So we need to identify that. There is one question: how much years of data is good for predictive analysis, and what ratio should for training and testing is better? Here I can suggest that minimum 10 years data is good for the analysis. But if you are getting more data, more than 10 years, then it will be very good, because as your data is more, your accuracy will be better. And with respect to different ratios, there are a lot of ratios available. But first, you need to understand that what is your purpose, what is your objective, what you want to do, what you want to interpret, what you want your what answer you want. Based on that, you select your ratios, because there are a lot of P ratios are there, EPS ratios, but you need to be very confident that what you want to do. So practically here, I cannot suggest exactly that these 2, 3 ratios are good. There are a lot of ratios are available, but based on your purpose and the business objective, you can decide your purpose. Okay, which are the website or software to study data? I think data cannot be studied, but yes, you can see that BSc, NSC data, the data is available on the website, historical data is there. You can take that data, use the software, analyze that data, and do your predictions. But we cannot study the data, but we can collect the data and then we can do some prediction and then we can interpret. So that will make your data to be studied. But in this case, there are a lot of websites. I think nowadays the NSC, BSc already on their website, they have a lot of data available. Investing is, screening is there, investing.com, lot of things are there. For individual investor, which data tool is suitable? It depends on how technically you are sound. But suppose you are at the initial level of data analysis, so Excel is also the good option. So go for the analysis. In Excel, we have add-in data analytics tool pack. You can use that. That is sufficient. But if you want to move for advanced part, then you can go for basically, I prefer R. If you go for the visualization, then you can go for Power BI or Google Data Analytics. That will make that is the easiest way to do. There is one more question: how do I adjust the regime change and basic relation changes in data? When do I evaluate and update the model? See, evaluation of the model is based on the validation. What validation will come? Suppose if your data validated at 80%, in that case, there is no need to update the model or evaluate the model. But if your accuracy level is less than 60, then you can go for updating the model and you can evaluate it further. So basic relationship is based on what are the factors you are taking in your data analysis. That is most important. You can see how to identify that there is a fourth in market. SEBI intervened and did stress test on MF. Since then, market is sideways. On this, I cannot comment, but yes, again, the all the MF and the stocks works on a different front. The data analysis is required for this type of thing as well. Please suggest some name of good books and source of information. Yes, source of information, I already say, if you want data, go for BSc, NSC. But good book, I can suggest, there is one book in quantitative analysis by Greld Keller book is there. That is a good book. You can take that for to learn all these things. Could you suggest the tool required for correlation and regression used by stock traders? Tool, you can use Excel. Excel is the best at the initial level. If you want Excel, in Excel we have inbuilt data analysis, so that you can go for that. I cannot answer. This certificate will receive through email. I think like the administration staff will confirm that. If you have any questions, yes, any questions? Which site is good for getting good data, qualitative data? See, for the qualitative data, then you can go for qualitative data is available in the different newspapers like Economic Times, Times of India. So you will get qualitative data where all that economic markets where they will give the feedback about particular stock. So that you can do by your own. So you can take a qualitative data through Facebook, then different YouTube videos, what are their views on the different stock. So a lot of data is available. How we can find the different ratios are okay for buying a stock, explain in this Zoom. Uh, See, there is no particular ratios are there. There are different ratios you can consider because again but at least you can consider minimum four ratios while buying or analyzing the stock market. Take at least minimum four ratios or five ratio is minimum is required. So you can take by your choice whatever data available. PE ratio is most important that you can take. EPS earning per ratio is also very important. So this two, three data, which is commonly ratios are commonly used, you can consider that data. So that data you need to take. How we can extract qualitative data from ratio? Okay. Qualitative data, I think balance sheets are there. You can convert actually, for the qualitative data, we need to recode the data and make it measurable. And then you can convert them into the ratios that we need to recode the data. Could you please repeat the name of the book? Okay, in the chat box, I will just write the name of the book if you want. So that is a Grailed Kaler book is there. That book is very good for learning all these tools. Basically, it is good for Excel and advanced Excel. I've already mentioned that book name. So that you can, while analysis of data, weekly data, which is the best analysis and prediction? I always consider daily data is the best data to do the analysis because as you are taking the daily data, lot of data will get collected and you can do the analysis. Economic data vs financial, which one is good for the investment? Actually, both are the good, but financial data is most important, followed by economic data. But if you are taking both the data set, both are the good for investment purpose, but financial data is most important. Economic data you can leave, but I cannot recommend. Take both the data. Do we fully rely upon financial data for investment? Not only rely on financial data. There are a lot of technical indicators are there. Market data is there. Qualitative data is there. So we need to take a overall picture of the data, whether it is qualitative and quantitative, and then we can rely on that. I use Minitab 14 analysis, work good on the same. I get my charts over there and appreciation is, no, I think Minitab 14, if you are using that is good, but now eViews are also there. But Power BI is there if you want to create a dashboard. But if you are comfortable with Minitab, please do all the analysis only in the one tool. Don't take two, three tools and do your analysis. Don't do that. And if you are using Minitab 14, do that. Do all the work in that. How better is to work with AI? Again, I am saying AI is a opportunity to understand and to understand what are the different phase of the data. But we cannot rely. We need to justify our AI outputs with our data analysis. That is most important. As you mentioned, people are using data and analytic tool for selection. So if we all are using the same technique for selecting stock, would there be overcrowding? Actually, everyone will not use the same data. Someone will take 5 years, some will take 10 years data. So, and everyone will take a different data points, and as well as everyone will take a different ratios. Everyone will take a different factors. So, maybe it depends on that. What are the factors we considered that is really impacting the market? So, the overcrowding will not be there because analysis will be different. Analytical tools are different because there is a constraint on the data. Some of the tools are applicable on numeric data. Some of the tools are applicable on qualitative data. So the answers will be 100% different. RSI, actually RSI is only one of the parameter. If we say it is a greater than 20, then you can buy. If it is less, then you can sell. But not only RSI will make you, there are other things also you can go for that. Even after good performance of the company, data analysis tool is not moving for longer period. Any views? Even after good performance of company, data analysis still stock is not. Yeah, that is there the possibility because of the sentiment analysis, views of the investors for that particular company, what are the news are getting displayed in the market. That also make a important thing in our analysis part. So not only the performance of the company will give you the good, like a stock will move up. It is not that way because there are a lot other parameters are also the important. Uh, I think it is there. Book name I already mentioned. Uh, Gerald Keller book is there. I already posted in the chat box. Okay, class. I hope I answered all the questions. But if any questions, we have 2 minutes time, so we can I can answer that questions. Any questions, class? Okay, I think there is no questions. Sahil, I already posted the book name in the chat box. Just check. I think some of them are saying they are not able to see. So just
Yeah.
check once.
Yeah. Wait, I
Okay.
will post it again, ma'am, for them.
Okay, Sahil. Thank you so much. I think we can
Yeah.
close the session. Thank you, everyone. And just do best in your investment part. All the best. And just play around data analysis. It is really a fun and good opportunity for you to learn many things together. Thank you so much and all the